This section deals with year-end adjustments. What is meant by year-end adjustments? Well, year-end adjustments relates to the accounting policy of the business and also to compliance with GAAP. GAAP is the generally accepted accounting practice that all companies that are registered need to follow. And specifically, the principle that needs to be complied with here is the matching principle. And you'll remember from the matching principle that it says that whatever incomes we show in the financial period, we also have to show the consequent expenses. So when we then deal with incomes and expenses, and some of them might have been incurred but not paid, or some of them might have been paid but not incurred yet, and so forth, then we need to do what is called an adjustment at the financial year end in order to ensure that the books in the business only shows those incomes and expenses that relate to the activity of that financial period. So then adjustments are made at the financial year end of the business, and examples of adjustments would be for depreciation, for prepaid expenses, in other words, expenses that we've already paid but which was not due yet. An example of this would be rent that you pay up front before the month even starts. Another example of an adjustment that needs to be made is accrued expenses, in other words, expenses that you've incurred but that you haven't paid yet. Accrued income, same thing, income that you should have received but that you haven't received yet. Income received in advance, in other words, income that you've received which wasn't due to be paid to you yet, and then a provision for bad or doubtful debts. So let's look at each of these individually and what effect they would have on the accounting equation. First, let's look at depreciation. Typically, the transaction would say the following. Depreciation on machinery for the year is 1,250 Rand. Now, if we use the technique that we applied in previous sections where we ask ourselves the three questions, in other words, firstly, which two accounts are involved, what type of accounts are they, and do they increase or decrease? And consequently from there then, are they debited or credited? Then for this specific transaction, we see the following. Firstly, which two accounts are involved? Well, because we're writing off depreciation, clearly depreciation is one of the accounts involved. The account that goes with that is accumulated depreciation on machinery, because if you've watched the section on depreciation already, you'll know that every year when we write off depreciation, the total gets carried over to the accumulated depreciation account, and that actually makes the value of the asset less in the balance sheet. So if we had to then classify these items, we'll see that depreciation in the year is seen as an expense. If you're not too familiar with depreciation anymore, please watch the section on depreciation separately as well, because there we explain this again. Depreciation, the actual expense for the year, reduces my owner's equity, and the total then, the running total of all the depreciations that we've written off on the asset is seen as accumulated depreciation. And when we have to classify that, it's a little bit different or difficult because it's not an asset or a liability or owner's equity per se. It is what we call a contra asset. Contra meaning opposite. So what happens in this case is the accumulated depreciation gets deducted from the cost of the asset or the value of the asset in the books of the business, and therefore we call it a contra asset. So it has the opposite effect on assets. So if we then look at whether it increases or decreases, we'll see that depreciation, because it's an expense, the actual expense increases. Remember, it's a non-cash item, so we didn't physically pay out money, but it reduces the profit that we have available in the business because the value of our machinery is reducing every year, so we're losing value on it. But when expenses increase, it also means my owner's equity decrease. Again, if you're not too familiar with this, please look at the previous sections where this was explained. On the other hand, the accumulated depreciation on machinery, because it's a contra asset, it means it decreases my assets. My assets actually decrease. And if we had to put this into a general journal entry, because normally when we do year-end adjustments, we do it in the form of general journal entries, then depreciation will be debited, because an expense, when it increases, is debited, and my accumulated depreciation will be credited, because when an asset decreases, it is credited. Again, if you're not familiar with the general ledger or the general journal, please refer to the other sections that's been recorded for your benefit in this regard. Okay, so just to summarize, depreciation as an adjustment means that I need to adjust the value of my machine at the end of the financial year, because it's now actually worth less again. So the two accounts that are involved is depreciation and accumulated depreciation on machinery. Depreciation is seen as an expense, so my owner's equity decreases, and accumulated depreciation is seen as a contra asset, which means my assets decrease. The next item that we can look at, the next adjustment, is prepaid expenses, and typically a transaction would be worded as follows. The business paid the insurance for the next financial year, 9,500 Rand. So what they're saying to you is, we've already paid for this insurance, but it actually belongs in the next financial year, not in this one. And the matching principle states that we can only show expenses that was incurred for this period. So even though we've paid that, we need to take it out of our books and put it into next year's books, because it doesn't belong in this financial year, it belongs in the following financial year. So when we then have to classify these accounts, it becomes important to understand this concept. Firstly, what will be the two accounts involved? Well, I pay insurance, so insurance must be the one. And because I have paid it for the next financial year, I have prepaid it. So prepaid expenses is the other account that is used. So let's classify. Because I have paid something in advance already, I've prepaid my expense, it means that I didn't really have to do that, and that money does not belong to the person to whom I've paid it yet. Not really, because it wasn't due to be paid to them yet. So when I look at prepaid expenses then, in the books of the business, I can classify it as an asset, because really that money that I've paid still belongs to me until such time as I have received the benefit for the expense that I've paid. So when the payment becomes due in the next financial year, only then does it actually become the insurance expense. For now, the fact that I've prepaid it means that I'm sitting with money that really belongs to me, and prepaid expenses is then seen as an asset. And it's seen as an asset that increases because all of a sudden that money that I thought I had paid actually belongs back to the company again. Insurance, on the other hand, is an expense, and because books of the business would have shown an increased amount that was paid for insurance, and we now have to decrease it, it means that my owner's equity will increase. So the actual account in the general ledger will decrease, so the expense account, insurance expense account, will decrease, which means that it has the opposite effect on my owner's equity, and therefore owner's equity will increase. If I want to do the journal entry, I need to decide what will be debited and what will be credited. Prepaid expenses will be debited because an asset increases on the debit side, and insurance will be credited because an expense decreases on the credit side. Okay, the next example is for accrued expenses. So accrued expenses means I should have already paid the expense, but I haven't, It means it belongs in this financial period, and I should have shown it, but I haven't shown it yet. For example, the wages for the last 2 weeks of the month were not paid, 2,500 rand. So what are the two accounts involved? Well, firstly, wages, because that's what we're paying, and because we pay wages cash, and we haven't paid it yet, it means that we've got accrued expenses. So let's classify these accounts then. Wages, is an expense, and because we were supposed to pay them, we therefore have to increase the wages expense account to show what the total for wages spent for the year would be, or should actually be. On the other hand, we have accrued expenses, which is classified as a liability because it's something that we should have paid and we haven't paid it yet. So we owe that money. We owe the money to the workers in this case because it's wages that we were supposed to pay. And that means that our liabilities are more because we have not yet paid those expenses. So when we have to decide what gets debited and what gets credited, we have to look at these two items, wages being an expense that increases, and expenses increase on the debit side, and accrued expenses then being a liability that's also increased, and we know that liabilities increase on the credit side. So when you go through all of these steps, if you made a mistake somewhere, it will show when you get to the final stage, when you decide what gets debited or what gets credited. Because if you end up with a situation where, according to your formula, both shows debited, then you know you've made a mistake somewhere and you need to go back. You either classified incorrectly or you showed the increase or decrease incorrectly. So please use this as a test to make sure for yourself that you've actually classified correctly and that you've decided correctly whether the accounts increase or decrease. Okay, so that's accrued expenses. The next one is accrued income. Typically, a transaction would look as follows. Interest on fixed deposit has not been received yet, 880 rand. Okay, so what is accrued income? It is income that we haven't received yet and that we should have received. So in the books of the business, we should show this income because it was due to us, but we haven't received it yet. So really somebody now owes us money. In this case, the institution where I invested the money, let's say it was a bank, where I took out a fixed deposit, the bank actually owes me the money, and they should pay me that money in this financial year still because it belongs in this financial year. They probably won't, and that's why we do an adjustment at the end of the year because we're not at year end and we haven't received the money yet. But in the books, we have to show that we were due to receive that money. We were supposed to have 880 rand extra interest on our fixed deposit, which is now not shown in the books. So when we classify, or when we decide firstly what are the two accounts involved, obviously the one will be interest received or interest on fixed deposit that tells us exactly what it is that we're receiving. And the other one will be accrued income. Because we haven't received the money yet, we can't actually put it in, we can't show it in bank because we haven't received it in the bank yet. It is still outstanding and therefore it's seen as an accrued income. So let's have a look at the classification quickly. Accrued income can be classified as an asset. Why is it an asset? Because that money belongs to the company. We haven't received it yet, so the bank can nearly be seen as a type of debtor because they still owe us the money, but that money belongs to us. We own it, and we should have received it. So accrued income is then classified as an asset. Interest on fixed deposit is always shown as an income. In our income statement, it's added to my gross profit. And because when an income increases, it also affects the owner's equity. My owner's equity is also shown in this table. So again, if we look at the increase or decrease, my incomes increase, which means that my owner's equity also increase. And on the opposite side, accrued income, we said, is classified as an asset, and because we are still owed that money to us, that asset should actually increase. It's shown as an increase because we should have received the money and it is due and payable to us. So assets increase and owner's equity increase. When we have to decide what is debited and what is credited, we simply need to look at the classifications and whether they increase or decrease, and that will then tell us what is debited and what is credited. So an asset increases on the debit side, and the income increases on the credit side. The next adjustment we will look at is income received in advance. So this is now the opposite. In other words, we've already received the income, but it was not yet due to us. So really that money doesn't belong to us yet, and we shouldn't have received it, but the person paying it to us was a bit ahead of themselves and they paid it already. Typically, for example, this would be rent that is paid on the last day of the month for the following month. So an example of a transaction would be the rent income amount includes 2,300 Rand for the next month, and that next month falls into the next financial period. So I wasn't supposed to have received the income already. It belongs in the next financial year, and I have to take it out of the books for this year because the matching principle states that I can only show income that was due to me for this financial period. So when I have to decide what are the two accounts involved, then the one will be rent income or rent received, and the other one will then be income received in advance. So let's have a look at the classification of these two. Firstly, rent received. We know that rent received is an income. But in this case, the income doesn't increase, it decreases. Because remember, the total in my rent received account in the general ledger will show a bigger amount than what I should have gotten for the year. Because included in that amount is 2,300 Rand that actually belongs in the next financial period. That means that my income needs to decrease with the 2,300 Rand, but when an income decreases, my owner's equity also decreases with that same amount. On the other side, income received in advance, because I've received the income and I wasn't supposed to receive it yet, that money actually does not belong to me. It still belongs to the person who paid it to me, and I merely can then be seen as owing that person the money until it is due to be paid to me. So in a sense, we can see it as a creditor, and that's why it's classified as a liability, because I shouldn't have received the money yet, and therefore I really still owe it to the person who paid it to me until such a time as it's due to me, which is only in the next financial period. So income received in advance is classified as a liability, and it increases because I now owe that person more, because they paid me money that I wasn't supposed to have. Okay, so on deciding whether it will be debited or credited when I do the journal entry, let's then just have a look at the rent received being an income. An income decreases on the debit side because normally an income increases on the credit side. So in this case, because my income decreases, it would be a debit entry, so rent received would be debited. And income received in advance, because it's a liability that increases, liabilities always increase on the credit side. So I'll know that I'm right because I've got one debit and one credit. The last item is provision for bad debts or for doubtful debts. Now what this means is that in the company we assume that not all debtors will be able to pay us the amount that they owe us. People go bankrupt, companies close down, they might owe us money because they've bought goods from us on credit and they now can't pay us the amount anymore. So we have to make provision for the fact that we might not get in all the debtors that we assume that we should be getting in. So in our balance sheet, when we look at the current assets, and debtors is one of the current assets that we have, we actually cannot assume that if the amount in the balance sheet for debtors is 10,000 Rand, that we will actually receive 10,000 Rand from debtors in the future, because we always have to assume that there will be some of those debts that will have to be written off as bad debts. In other words, we cannot get that money in from those debtors, so we write it off as bad debts. In the year where we write it off, those bad debts are seen as an expense. Again, like depreciation, it's a non-cash item because we don't actually physically write out a check, but we also are not getting the income from the debtors. So it reduces my profit, which means that it's seen as an expense. But the provision for bad debts is something that we do at year end to say we assume that we are not going to get in all the money and we are providing for that, so that the picture in our balance sheet is a more realistic picture of how much money we think debtors will pay us or what the value of our debtors are. Okay, so typically at the financial year end, when we do an adjustment for bad debts, we would have a transaction that says provide for bad debts to the amount of 3,000 Rand. This could also be changed to say increase the provision for bad debts with a certain amount or decrease the amount, because we could have provided for bad debts already in a previous financial year and now we just want to adjust the amount up or down, or just let it stay the same. In this case, we will just show what happens when we provide for it from scratch when there hasn't been a provision. Obviously, if there has been a provision and you have to increase it, then you would do exactly the same as what we're going to do now, because you're going to just make it more. And if you have to decrease the provision, you'll do exactly the opposite, because then you want to decrease the provision. Okay, so let's have a quick look at which two accounts are involved. The accounts that are involved is exactly the two that I've been speaking about now. The first one is bad debts, which is the actual expense that we write off in the year. So whatever money we can't get from our debtors in this financial year that was owed to us gets written off as bad debts in our journal. And the other account that we work within is the provision for bad debts. And this is an account that will be shown in our balance sheet. So bad debts is an expense that will be shown in the income statement. And provision for bad debts is an account that will be shown in our balance sheet, because it will reduce the value of the debtors in the balance sheet. Okay, so let's have a look at the classification. So we said the two accounts involved is bad debts and provision for bad debts. And we've also said that bad debts is seen as an expense, which means that it will decrease my owner's equity because it's an expense that increases. So I'm saying that there's probably an amount of 3,000 Rand that I'm not going to get in. So I'm writing off 3,000 Rand as bad debts in this financial year. So the expense, the bad debts expense in the books of the business will increase with 3,000 Rand, but that means that my owner's equity decreases. In terms of the provision for bad debts, I've just said that what happens is it's shown in the balance sheet, and it's shown as the value of debtors being reduced, which again means that it's seen as a contra asset, the opposite of an asset, because what it does is it reduces the value of the asset. So just like accumulated depreciation reduced the value or the cost of the machinery and the vehicles and all of those other assets we had, so does provision for bad debts decrease the amount or the value of the debtors in the balance sheet. So it's seen as a contra asset. And when it's seen as a contra asset, it does the opposite to what happens to an asset. In other words, it decreases the value of an asset. So if you look at the accounting equation, you'll see that on the left-hand side, assets decrease, and on the right-hand side, owner's equity decrease. So I know that I've worked it out correctly because my mathematical accounting equation works. Assets decrease and owner's equity decrease, and they're each on the separate sides of the equation. If we have to go that one step further then and do the journal entry and decide what gets debited and what gets credited, all that we then need to do is to look at the elements. Bad debts is an expense, and an expense increases on the debit side. And provision for bad debts is a contra asset, which means that my assets decrease, and assets decrease on the credit side. So it balances because I have a debit entry and I have a credit entry. If you're not too familiar or not too sure about debit and credit entries and how to work them out by using the accounting equation elements, please go to the section on general ledger, where we again explain how to decide which account gets debited and which account gets credited. And just refresh your knowledge there again about that. Okay, so those are the elements of year-end adjustments. Those are the 6 adjustments that you could be asked to do. Just for the last one again, provision for bad debts. As I said to you, when you have a situation where they say that you have to increase the provision, then the entry will look exactly the same. Bad debts will be debited by the increased amount, and provision for bad debts will be credited by the increased amount. And if you have to do the opposite, so if you have to reduce the provision, you might have decided last year to make a provision of 3,000, but you're only in the end wrote off 1,000, so you don't want to make too big a provision, and therefore you want to reduce the provision for this year. Then the opposite will happen. So you will debit your provision for bad debts to make it smaller, and you will credit your bad debts to take it out. Okay.